Hi, good morning. Welcome to this paper 5 tutorial. I'm Dr. Augustine Chow. Today I'm going to prepare some copying notes for you to understand the paper 5 investment-linked insurance policies. And I hope that you can find some benefits out of it. Okay, let's start. And we'll start from here. And because of the PowerPoint do not have the English version, so I have to use the Chinese version and then explain it. And this is paper 5. And I skip the administrative features and then, okay. This paper 5 investment link policies long-term business has 80 questions. And 32% of them are in the investment link long-term business policies. And there are 26 questions out of that. And 28 questions will be from investment assets. And that would be the easiest part, I think, on book knowledge. Don't forget about the Hong Kong regulation framework, which and 8 questions, which about 10%, and which can be a make or break type of questions to help you to pass or disable you to pass in this examination. And 2%, 2.5%, 2 questions on investment link, introduction questions. So this is how the paper is structured. 8 questions, I think, in 2 hours. But you can choose a paper or pencil examination, or you can choose a computer-based examination. And we have the mock exam. So you at least spend 30 hours in it. And recently, they've been adding more calculations questions into the paper. So you must know how to calculate the future value, present value, and the rate of return, etc., and etc. So the first part will be an introduction to the investment-linked long-term insurance policies. 2 questions on it. And they required a special long-term business license, Class C license, to provide this type of service. So not all the insurance companies, life insurance company, can offer. They have to apply for the long-term Class C license for long-term business. And for this Class C license, they have to put in, I think it's additional 10 million capital to support this kind of business. And what is it about? Basically, it is the policy that the policy value varies according to the investment that the client has chosen. So it fluctuates, can go up and go down. And the clients have the choice of the investment assets they want to put in the policies, and they have to accept all or part of the investment risk. And that's basically it. So unlike other insurance policies, annuities, or other long-term business, they have an investment portion in the policy. And the investment policy is called, in England, called the unit link life insurance like policy or unit link annuities. And in American, they call it variable life annuity, just a term. In American term, variable. In English term, we call it unit link. In AIA, we call it ULS, unit link life policies. And there are a few options in the unit link policies. We call it variable policies. That means they could have a fixed premium variable life, a fixed premium for variable life, meaning different terms, different lives. Or they can be a flexible premium variable life. Everything is changing. The premium level can be changed, the term can be changed, the protection can be changed, and the cost of insurance can be changed. It's very flexible. And for this type of policy, we call it universal policy, universal variable policy. That's most common American terms. The difference is that In traditional policy on the left-hand side, that the insurance company takes all the investment risks. They propose a product, give you an anticipated return of 3.5%, for example, and they make all the investment decisions. 80% in bonds and 20% in stocks, and they can change the portfolio from time to time to give you the 3.5, and that is why that is not guaranteed. But if they can make more than 3.5, they build in a reserve in the bonus pool and they give you 3.5% over the years. So in some years, if they cannot meet the 3.5%, they will take money from the pool, and that is why you have a non-guaranteed reversionary bonus. But in a unit-linked policy, that the customer has to absorb all the risk. The customer should open an investment link account and make his premium, part of the premium, into an investment or some sort of investment, a portfolio investment, for example. And the portfolio value could vary up and down during the period. And the value of the policy, the life benefits, may vary. So on the left-hand side, traditional policy have a fixed or guaranteed death benefits, but on the right side, unit link, they do not have a guaranteed death benefits or definite annuity income for the clients. All of them are variable. It's non-guaranteed depending on the investment yield, investment return that the customer has made. So compare to the other policy, the unit link policy, the investment policy, they can invest in a lot of options. This pie chart shows that they can invest in assets, other securities, common stocks, fixed income investment, or bonds, commercial papers, everything. They have all the options. But the customers to choose what kind of options he would pick and place in the portfolio. And all the investment link policies, all the funds has to be approved by the Security Commissioner. So it is a very supervised collective investment plan in forms of a unit trust. And the C class license will enable the insurance company to work with asset management companies, investors, and asset fund managers, and to provide two types of products: unit link annuities, unit link life policies, or variable link, variable premium, variable life, flexible premium policies. And it is governed by three ordinances: the Protection of Investors Ordinance, the Insurance Ordinance, particularly the Class C investment link guidelines. This is a regulated framework. So in this paper, we have several chapters to talk about the mock-up examinations and the contents. Historical development. I think the life policy has a history of 400 years, starting but the unit link of variable life, universal life policy, so to speak, also took place in the 70s. And in the 80s, American first invented this variable universal life policy in the 80s. And right now, between 10 years, I think they have increased this part as in personal life insurance in Hong Kong. Universal life. What is universal life? Universal life is a long-term life policy which gives you flexible premium and flexible death benefits, and all the administration fees, all the accounts, debits, the fees, the cost of insurance, administration fees, penalties, everything is listed. Like a traditional policy, which a lot of expenses are not listed. You will not know. You just know how much you paid and how much you will get. And you don't know the fees and the cost of insurance. But in your universal life policy, everything is so transparent. You know everything. The key is that for these, the investor or the policyholder have a wide range of investment options, but it also the risk of management of the risk of managing those investments right now in the hands of the unit trust fund managers, but the risk is ultimately transferred to the policyholder. They have to take all the investment risk. Variable universal life. It is a flexible premium and a flexible death benefit. Everything, the risk and the return is transferred to the policyholder. It has two benefits. It is a variable life benefits and is variable premium. And there are different terms for the same thing: variable universal, unit link, or investment link policy. In Hong Kong, we call it investment link policy. In UK, we call it unit link. In America, we call it variable universal, just different terms for it. And in a traditional policy, the premium to be paid consists of three components. Cost of insurance means the death mortality rate. They have to build in the reserve to pay out according to the mortality rate. And then the insurance company's operation and selling expenses, or the reserve, or the profits, how much profit they make, they build into the premium. And also they add in the investment and interest gains, profits into the premium. But in a investment linked long-term business policy, uh, the risk and reward is transferred to the policyholder. And so the cost of insurance, all the investment expenses, fund managers, investment fund expenses, administration expenses, everything is transparent. So made known to the policyholder. And also you can pick into currency funds, bond funds, or common stock funds, everything. And all the expenses, the market expenses, insurance expenses, administrative expenses, distribution costs, commissions that paid, and the marketing promotion, all the fees are transparent, made known, and separate, listed in your account. So, in the premium that you paid, consists of several components. One is the cost of death, which is the cost of insurance, depending on the risk class and depending on the insured amount. And they pay for the death, pay for the annuity and other insurance benefits. So that is one fee, one amount that they charge. That the second is the policy fees. There may be upfront fees, they may be withdrawal fees, they may be a funds transfer fees, they may be a early prepayment penalty, withdrawal fees, which pays for the marketing expenses and all the promotion expenses for managing the fund and marketing the fund. And there is also an administration fee, which is a fixed percentage to pay for the administration of the policies. So free fees that are separate from the policy. And how they can recover the fees? They can have recover the fees in different ways. One is called a bid and offer spread. That means if you buy the funds, if you one price, if it's out it, there's another 5% difference. And the 5% is the fees that will be charged over the funds. And there will be a fund management fee deducted for the investment gains. And there's a fund switching charge, might be a fund switching charge, which charge from one fund to another fund. There's a switching charge. And if you surrender the policy, there is a surrender charge. And also when you top up, meaning increase the investment, there may be a top-up fee or other fees of changes of the charges of the underlying fund. So there are A, B, C, D, E, F, 6 types of funds. But in AIA, we do not have a bid and offer spread, which is one price, buy and sell the same price. So we have to make the recover the administrative expenses by other types of funds. There will be a top-up fee. There will be a surrender charge, prepayment penalty within the first 6 years. But AIA funds do not charge for switching from one fund to another fund. There is a fund management fee. There is a surrender charge fee. There's a top-up fee, but no bid and offer fee. And also there is administration charge every year. Bid and offer rate is designed in a 5% spread between the buy and sell price, the bid price and the offer price. Bid price is the price you want to buy in new units. The offer price is when they sell it to you. So there is a 5% spread. Recover the marketing and the insurance operating expenses. And there's a fund management fee, which right now is about 0.5% to 1% charged by the investment fund managers. This will be the commissions or rewards for the fund managers to make a better gain for the investors. And the better gain, the more investment return, the larger the fund, the more investors coming in to make a larger income and bonuses for they pay. How active they are, how much profits they make, and the type of assets. And they have to face the competition. So this fee is normally within the range of 0.5%, half of 1%, or 1% max. And for this fund switching fee, normally there are a minimum free times of change. Normally is 2 times a year. And for some funds, they eliminated this fee. There's no fund transfer fee. And this is the surrender charge. Surrender charge is to take out from your selling of the funds when you take money out. And if you make return, you don't mind paying this surrender charge. But if you are losing money, this surrender charge could be a cost to you. And the first year surrender charge would be 100%. If you take out the money within the first year, then all the money you put in the investment account will be for these charges, for the recovering of the marketing expenses of the fund. So pay attention, this is the surrender charge. There may be a top-up fee that when you are making additional investment into accounts, there will be a top-up fee. And other fees like a trust fees charged by the trustee company and a admin fee by the fund managers. And there will be a administration investment management fee. So when you redeem the fund or subscribe to the fund, there's an upfront fee that maybe that the fund manager may charge to recover the development cost and the legal compliance cost for administration of the unit trust. The types of investment-linked long-term policies, there is 2 types. Investment-linked annuity, which is not popular, which is not offered in Hong Kong. The other one is investment-linked life policy, and we're talking about life policy here. It's more popular. Again, it is a flexible premium, flexible protection amount, flexible death benefits. The death benefits can be increasing, can be decreasing, can be variable, or can be 105% of all the premiums you paid. So 5% more than you have paid. It's a 105 plan. And as long as your money in the account is sufficient to pay for the cost of insurance, then you do not have to pay for the interest. Yeah, but you have to keep a minimum amount in the unit-linked account. It's like a bank account. You can deposit money into it, and you can take money out of it at any time, after a period of time, after when you have a surrender charge, free surrender charge. Normally it's after 6 years. And you can deposit in to get out without any charge. So for some investors, they want to make a single premium plans. They just put in a large sum of money, say 1 million, 2 million US Hong Kong dollars into the fund account and then take advantage of the investment. Or they can make a regular premium payment, 5-year plan, 10-year plan, so that they can take advantage of the average cost of the investment. So 2 ways are also very common. And how this works, your premium that you paid could be used for buying new units, new fund units. And you can buy and sell units and then take money out from it, and the remaining of the money will be retained in terms of units in your account. and that unit has a market value that is declared every day. So this is yeah, this is the basic understanding. So this question is asked: an investor made in a investment account and put in some money according to the net asset value (NAV). Let's say if they put in 100,000 Hong Kong, and at that time the unit rate (NAV) is $18 Hong Kong. How much they can buy? How much units they can buy? Well, and for example, when there's a buy-sell spread of 4%. So if they buy at $18 and when they sell, they will sell at 18.72. That is adding 1/4% of the bid and offer rate spread. When they want to buy, that means the unit of the fund sell you the units, it will sell at 18.72. So you will get 5,341.88 units. And that's how they calculate. Well, the benefits of free plans, increasing death benefits. We call the IDB, increasing death benefits, or level death benefits. That means over the years, no matter how much money you have in your account, the death benefits will be the same. Or there will be a 105 plan that the death benefits is always 5% on top of what you have put in. And of course, the premium is larger for increasing the benefits, larger than the level death benefits, and larger than the 105 plan. Return on gross premium. How do we compound gross premium? Let's say a policyholder has a 12-year investment-linked policy and also paid $57,000, and he was given 2,413.26 units after deducting the fees. And at the time, we buy-in price, they bought it at 13.4, and he expect the unit price will increase by 7.8% compound. So what will be the gross premium returned? Well, let's first calculate forecast the future value of the units after 12 years according to 7.8%. And that is 13.4 times 1 plus 7.8% to the power of 12. Then it will give you an expected return of after 12 years of $33. And $33 at 12 years later at the units. The unit have not increased over the 12 years, but the price. So ultimately he will get 79,638.5%. And if you're calculating the gross return, then you put in this formula, 58 plus 1 plus R% return to the power of 12, and you divide it and calculate that the compound rate of return is only 2.83%. And this is how you calculate on the financial calculator by getting a square root of 12 power, and you get a 2.83% compound annual return, APR, annualized percentage rate, 2.83%. So that's why you need a financial calculator to take in the examination room. All right, basic calculations of regular premium policies. In the first 3 years, taking off the administration fee, the cost of insurance, 100% will be put in after 3 years. 100% will be put in for the investment after deducting of the fees. In the first year, they will deduct all the fees from you or the death benefits from you, and you have $0 into the investment. You put in $500 into account for the first year. $500 will be absorbed by all the fees. You will get no investment return in the first year. In the second year, your $500 will be $250 will be used for investment, and only after 3 years, the $500 will be totally invested, and that is how they recover the marketing expenses. And this is the same with traditional policy. In traditional policy, normally the first 5 years you have very little return when you surrender in the first 5 years. Exactly the same principle. Okay, the structure of investment linked policy and the accumulated investment returns with profits will be reinvested into the new units, and that will be in the dividends policy. And so you will increase the number. If you make some profits, you increase the number of units that you hold, but the unit price will not be changed. That's how you make the return. So, in summary, um, investment policy, they get an investment annuity, investment life policy. For life policy, then you can pay a lump sum payment or the single premium, or you can pay the fixed premium. In EIA, we call it the treasure account, and also called the fixed investment. I mean, the fixed period investment, we call it the treasure account plan B, plan 2. And the money will be used to buy some units or sell some units, and then the death benefits of it may be increasing the ID of level premium or 105 plant, and the profits can be distributed in terms of fixed income. They will distribute the investment link every month, but they can accumulate in the account to buy some new units for the profits. This is how unit link policy is structured. Oh, there are many funds for you to make. Bond fund, investment bonds, index fund in that invested in a stock index. Global funds spread around the globe, any place in the world. Specialty funds put in real estate assets or energy sector. Balance funds that they have a balance of income, fixed income, securities, long-term funds, short-term funds, according to the investors. I mean, the fund managers. You can have a guarantee fund, which is a low return, but guarantee normally invested in government bonds. You get equity funds, invest in common stocks. Warrant funds, invest in warrants. Regional funds or country funds can be invested in Hong Kong fund, China fund, American fund. Income fund, investment in fixed income securities or bonds. Growth funds in terms of long-term assets, and fund of funds is umbrella investment into other funds. So it's umbrella type of arrangement. So all the options in the unitized funds. Types of investment linked funds, currency funds, they will in terms of deposits, bank deposits, currencies. So it's very liquid, very stable, but very low return. Um, Bond funds invest in government bonds and commercial bonds. Commercial bond meaning bonds by the listed companies, and they offer better rates than the government, and the return will be slightly higher than the currency funds. We call it bond funds, and they can also make advantage of the interest rate changes. When interest rate rise, well, bond price will be lowered. When the interest rate is down, bond funds they carry a fixed income will be the return will be higher. But that for this type of policy, then you have to bear the default risk of the issuer, if it's a commercial paper. And okay, securities, equity fund. They invest in equities for longer term investment. They can invest in more than one portfolio of common stocks. And traditionally, the returns has been higher and have been good for anti-inflation, counter uh, balance the inflation rate, and they can make use of the fund manager's investment expertise. And for these type of higher funds, they will have higher administration fees, but the risk is also higher because the companies, the common stock companies may bankrupt, may fall. Okay. Index funds. Index fund will just invest in, for example, Hang Seng Index, and there are not many of this. Hang Seng Index or the financial index easier to understand because if you know the Hang Seng Index, you will know how much you're making or returning. And the administration fee is lower, and you can balance it with the hedge it with the other securities. And the deficit, I mean, the effect of it is not catching up with the market, and it will never surpass the market return. In a rising market, it's not very common, but in a bear market, right now, there's a delayed effect. So you can use an hedging to your bonds investment or security investments. Warrant funds, these are higher, normally very high return, but more risky because they have leveraging on the warrants. So you have a bigger leverage for bigger return. Equity funds can be invested in all countries, international countries. Global investment is a good way of diversifying your common stocks. The risk is more costly, and because every country has different accounting rules, and the market information is always delayed, but you can invest in the global funds, the particular country funds, and particularly when you are just thinking that a particular country will experience high growth in other countries like China, and you just put all your money in the China funds. In China, you can have a China equity fund, China bond fund, but by investing in one single country, you have limited diversification. A special industry fund, which will give you the return of the special industry. For example, last year, highest fund growth rate is achieved by the real estate fund of the China, because they invest just in China real estate business, real estate companies, and they provide last year they provided 40% return on the fund, but also it is very concentrated and high risk. Uh, okay, fixed income. They invest in preferred stocks, bonds, commercial papers. They're medium term risk, very liquid, but very little capital appreciation. It's called fixed income fund. The balance fund invests in a portfolio of stocks and bonds combination. It is risk diversified and country diversified. Also, there's a medium risk, but in the rising market, you will not do better than the rising market. Okay, growth funds, something called growth funds. They're normally invested in common stocks, equities, in other lower reputation but very high potential smaller companies. So you invest when they are small, then you expect them to grow faster than the market. It's the expertise of the special funds manager investment in a SME, small medium enterprise, but high risk, and there's no guarantee, not very stable dividends from the company. No funds, we have this kind of investment portfolio. What is that? Oh, guarantee fund. Guarantee fund is a secure, most secure fund. There's no risk to the capital because it's guaranteed. And because of guarantee, they charge a fee for that. And the return is very low, but you can preserve your capital in the bear market. All right. And that funds of funds. Well, this invested in other professional managed funds. And it's very diversified, but again, they charge your investment fees on funds, and you also charge a double charge on the fund of funds. You have to pay more um, investment fees for it. So in terms of risk profile, on the right side is return, the top side is risk. The higher the risk, normally the higher return. So the high risk, high return things are the warranty funds, growth funds, specialty funds, and specific country funds. On the low end is the bond funds, deposit funds, and guarantee funds, lower risk and low return. In the middle are the medium risk and medium return, like the global funds, balance fund, index fund of funds, or fixed income funds, and the equity funds are medium risk and medium return. And let me repeat, the benefits of a unit-linked policy is a potential investment gain and a flexible investment plan. So the benefits, you have a wide range of investment portfolio combination with a wide range of death benefits. You can have a premium holiday. For some period, you can stop paying the premium, and you can make additional premium when it's a bull market. You can more investment, or you can make a regular investment, fixed investment, and the variable life benefits could be up, it could be adjusted up, could be adjusted down, it could be IDB, increasing death benefits, or level death benefits, or 105 plans, as long as you have enough funds to pay for the cost of insurance. Benefit from a professional managed fund with limited amount of money, you can invest in a wide range of equities, which is not possible if you have so small amount of money. And again, funds may go up and go down. There's no guarantee. And if you withdraw within the first 5 years, normally there's a prepayment penalty. You must keep it for the whole period. And you bear the risk of the default, um, uh, exchange rate, reinvestment risk, and interest rate risk. And also, the policy value may go down, the profit may go down to the period when you lose your money, then your policy is called it. It's not giving you the desired protection that you ask. The benefit of it is that you're entitled to receive the profit uh, in traditional policy, and you can participate in profit sharing, but in a unit-linked policy, and you have higher return, high risk, and you can only decide on your own investment options, but not in other traditional participation or non-participation policy. The premium is flexible, the death benefits is variable, and also you have three options: increasing death benefits, fixed level, or 105 plan. And the cash value is also variable, and a partial withdrawal, but not in a traditional participation policy. And SFC, Security Commission authorizations is required for investment policy. So that's it. That is the basic elements of investment linked policy. So we'll stop here for the time being and raise questions, and let's see, we'll discuss it and attempt some of the mock questions right now. Well, thank you for your attention. This is Augustine Chow, developing this tutorial for Paper 5, Investment Link Long-Term Business for our candidates. Thank you and goodbye. Wish you good luck in your exam.